Imagine buying a piece of a company, going to sleep for 5 years, and waking up to find your ownership stake has just essentially doubled.
Right, like some kind of finance fairy tale.
Exactly. You didn't spend a single extra dime. You didn't execute some complex options trade. You just held the stock, and your slice of the pie grew by a staggering 50%.
And it's not some theoretical finance class hypothetical. That is exactly what MGM Resorts International just did.
Okay, let's unpack this. Welcome to a special Talk Tickers edition of this deep dive. Our mission today is to cut through all the noise of the latest earnings cycle.
Because there's a lot of noise.
Oh, a ton of it. If you're joining us, you are likely a retail investor, right? Someone managing your own portfolio, trying to figure out where to deploy your capital. Or maybe you're just fascinated by the sheer scale of the global casino industry.
Which is fascinating all on its own, honestly.
Yeah, right. So we are going straight into the belly of the beast. MGM Resorts International's Q2 2026 earnings call. We're taking the executive's exact words, stripping away the Wall Street jargon, and, well, extracting the actionable intelligence.
The stuff that actually matters to you.
Exactly. We're going to break down the headline numbers, explore the actual story driving those numbers, look at their massive global expansion plans, and finally, our goal is to deliver an actionable verdict on the stock in under 5 minutes.
The challenge, though, for any retail investor looking at a company like MGM is that it isn't just one business.
No, not at all.
When you buy a share, you aren't just buying a casino. You're buying a convention center, a global live entertainment promoter, a digital sports betting platform.
In an ultra-luxury real estate portfolio.
Yeah, and a budget hospitality funnel, all mashed into one single ticker symbol. The goal here is to dissect those individual components and see if the underlying engine is, actually running efficiently.
So we have to start with the headline numbers because, frankly, the data from the second quarter is staggering. FGM just delivered record consolidated net revenue for a second quarter.
Record-breaking.
Yeah, we're looking at the highest top-line numbers they've ever achieved in this specific window. And what stands out when you comb through the transcript is that this wasn't carried by one lucky department.
Right, it was across the board.
Exactly. The Las Vegas Strip saw its second consecutive quarter of year-over-year revenue growth. Their regional operations, like the casinos in places like Michigan or Maryland, hit an all-time best for same-store quarterly revenue.
And don't forget digital.
Right. MGM Digital, their online operation, grew net revenue by 20% year-over-year.
See, when you see growth across the Strip, the regionals, and the digital footprint simultaneously, you're looking at a fully functioning omni-channel ecosystem.
Which is what everyone wants.
It is the absolute holy grail for modern gaming executives. It means the consumer is caught in the brand's gravitational pull. Well, a customer might place a, say, $20 parlay on the BetMGM app while sitting on their couch in Ohio, right? Then they visit the MGM Grand Detroit for a weekend, and then eventually book a luxury suite at the Bellagio for their anniversary.
The money never leaves the ecosystem.
Exactly. It's a closed loop.
But, top-line revenue is just vanity if you are burning cash to get there. As an investor, I want to know if that revenue is actually making it to the bottom line.
And that's where the EBITDA comes in.
Right. Looking at the Las Vegas Strip specifically, management highlighted that resort EBITDA was up $25 million. Just to quickly contextualize that, for anyone building their models, EBITDA strips out the accounting noise like depreciation and taxes.
It's the pure operational cash.
Exactly. It tells us if the day-to-day cash-generating engine of the business is healthy, and a $25 million jump suggests that engine is roaring.
But the underlying driver of that EBITDA jump is just as important as the number itself. Management pointed specifically to the recovery at the MGM Grand.
Oh, right, the room remodels.
Yeah. They recently injected a significant amount of capital into remodeling a massive block of room inventory over there. When they bring those upgraded rooms back online, they can charge a higher premium, which flows directly to the bottom line.
So it's immediate ROI.
Precisely. It proves to the market that their capital expenditure, their CapEx, is yielding an immediate, measurable return. They aren't just, painting the walls. Yeah. They are manufacturing pricing power.
That brings us to a piece of actionable data that directly impacts the retail investor holding the stock. Let's talk about the share buybacks, because this is where the math gets incredibly compelling.
Oh, the buybacks were massive this quarter.
Huge. During the second quarter, MGM bought back 4.3 million shares of their own stock, spending a total of $164 million.
If we connect this to the bigger picture, think of a share buyback like a pizza.
Okay, I like pizza.
Right. The size of the pizza, which represents the total intrinsic value of the company, hasn't changed. But management is basically going around the table, taking cash out of the company's register, buying slices from investors who want to cash out, and throwing those slices in the trash.
So there's less pizza to go around.
Exactly. By reducing the total number of slices, your one single slice suddenly represents a much larger percentage of the entire pie. And over the last 5 years, MGM's chief financial officer noted they've retired nearly 50% of their total share count.
They threw half the pizza away. Which is why your ownership stake effectively doubles. But let's look at the specific pricing of this quarter's buyback, because this is where I start wondering what management knows that the market doesn't.
The price disparity is fascinating.
Right. They spent $164 million to buy back 4.3 million shares. You do the division, and they're acquiring this stock at roughly $37 and change per share.
But the market price
was way higher. At the time of this earnings call, the stock was trading around $46. The CFO, Jonathan Halkyard, was actually pressed on this gap by an analyst, and he mentioned they believe the stock is undervalued based on a sum of the parts valuation.
Which is a classic Wall Street metric.
Right. But before we blindly trust management's optimism, what exactly does a sum of the parts valuation mean in this context? How does that justify aggressively buying at 37 when the market prices it at 46?
So a sum of the parts valuation is a method of valuing a company by determining what its aggregate divisions would be worth if they were spun off or acquired by another company.
Like breaking up the empire.
Exactly. Wall Street often applies what's called a conglomerate discount to massive companies like MGM. The market looks at the whole tangled web of Las Vegas resorts, Macau casinos, regional properties, and the digital app, and they just assign a slightly discounted blended multiple to the stock.
Because it's complicated to manage.
Right. But what the CFO is arguing is that if you were to chop MGM up, if you sold the Las Vegas real estate to a private equity firm, spun off BetMGM as a standalone tech company, and sold the Macau operations to an Asian conglomerate, the combined cash from those individual sales would be significantly higher than the current stock price.
So management is looking at their internal spreadsheets, seeing the true asset value of their empire, and realizing that buying their own stock is the absolute cheapest asset on the market.
Exactly. They're putting $164 million behind the belief that Wall Street has mispriced their company.
It is the ultimate signal of capital allocation discipline. They aren't taking that $164 million and blindly acquiring some struggling competitor just to build an empire.
No, they're looking at the landscape and saying the highest return on our investment right now is betting on ourselves.
But to fund a $164 million buyback while simultaneously upgrading properties, you need a fire hose of free cash flow, which naturally pushes us into exploring the story behind the numbers. Where exactly is this massive influx of cash coming from in an economy where, discretionary spending is supposedly tightening?
It's certainly not just people walking in off the street and pulling slot levers.
Right.
The modern casino floor is just the final stop in a highly engineered hospitality funnel. The bedrock of this entire financial structure, the foundation that allows a mega resort to operate profitably, is the group and convention business.
The corporate crowd.
Exactly. Management explicitly noted that group and convention business hit a 20% room mix in the second quarter, and they are modeling for it to hold at that 20% level for the entire year.
Let's visualize what a 20% room mix actually looks like on the ground. We were talking about tens of thousands of hotel rooms across their Las Vegas portfolio.
Massive inventory.
This means 1 out of every 5 rooms they own is booked by someone attending a tech conference, a pharmaceutical trade show, or some corporate retreat. Why is locking in that specific 20% baseline so critical to their pricing strategy?
Because it completely changes the math on the remaining 80% of the rooms. Convention bookings are locked in months, sometimes even years in advance. This provides a guaranteed baseline of occupancy.
So they aren't sweating the weekends.
Right. Imagine running a hotel with 5,000 rooms. If you wake up on a Monday and 1,000 of those rooms are already paid for by a corporate client, The panic of empty inventory just vanishes.
That makes total sense.
You can employ highly aggressive dynamic pricing algorithms on the remaining 4,000 rooms. You don't have to slash prices to attract budget travelers. You can hold your rates high, knowing your overhead is already covered by the corporate baseline.
And the data proves it's working. The corporate groups didn't just fill rooms. Management reported they drove the highest convention average daily rate, the ADR, in the history of the company during this quarter, alongside record catering and banquet revenue.
These aren't people looking for cheap buffets.
Exactly. They are expensing $200 steaks, renting out entire ballrooms for private events, and driving the absolute highest margin food and beverage revenue possible.
Furthermore, when corporate America pays for the room and the food, the individual attendee's own wallet is untouched.
Oh, that's a great point.
When that convention attendee finally walks out of the ballroom and onto the casino floor at night, they still have their entire personal entertainment budget intact. The convention business effectively subsidizes the gambler.
So you lock in the 20% with corporate money, but you still have massive mega resorts to fill every single weekend. Here's where it gets really interesting, because the strategy shifts from harvesting existing demand to actively manufacturing it.
Yes, the synthetic demand drivers.
Management cited their ability to capitalize on citywide live events, specifically calling out a massive diversity of attractions. They had a BTS stadium concert, major UFC pay-per-view fights, and the Vegas Golden Knights' deep playoff run.
This highlights the most significant evolution in the Las Vegas business model over the last 2 decades. Historically, gaming was the primary driver of visitation. You went to Vegas to gamble, and maybe you caught a lounge act while you were there.
Right, the cheap shrimp cocktail era.
Exactly.
Yeah.
But today, Las Vegas is arguably the premier global stage for live entertainment and sports. The gaming is secondary.
Wow.
When a global pop phenomenon like BTS performs or Conor McGregor fights, it draws an incredibly affluent, highly motivated demographic to the city. These are people dropping thousands of dollars on secondary market tickets before they even step foot on a property.
And MGM isn't just sitting passively hoping these concert goers wander into the Bellagio. They're programming the entire city around these cultural moments. They mentioned launching the Players Era Collegiate Basketball Tournament taking place in November across their arenas.
They're essentially creating their own synthetic demand drivers.
If a week looks soft on the calendar, they just invent a sports tournament to ensure the city remains at peak capacity.
It creates a protective moat around their earnings. They aren't reliant on the whims of the casual vacationer anymore. By controlling the arenas and the event spaces, they dictate the flow of high net worth traffic into the city.
It's brilliant, but it's heavily skewed toward the luxury consumer, right? The sports fans, the corporate executives, the concert goers, they're all premium demographics. What happens to the lower end of the MGM portfolio?
The budget properties.
Yeah, properties like the Luxor and Excalibur. They have historically catered to a very budget-conscious, value-driven consumer. I found a detail in the transcript regarding these properties that genuinely surprised me.
The all-inclusive experiment.
Yes. To stabilize these aging assets, management ran an experiment. They introduced a fully all-inclusive room and food package.
Applying an all-inclusive model, something you typically see on a Carnival cruise or at a resort in the Dominican Republic to the Las Vegas Strip, is a fascinating behavioral economics experiment.
Why do you say that?
Well, the budget consumer operates on a psychology of price certainty. They are terrified of the $20 cocktail and the $50 resort fee.
It ruins the vacation.
Exactly.
Yeah.
So by bundling the room, the food, and the drinks into one upfront price, you eliminate the friction of financial anxiety.
And the scale of the response was wild. They booked over 30,000 room nights on this all-inclusive offer in just 4 months.
30,000.
But the statistic that management themselves called startling was the demographic breakdown. Nearly 50% of the guests who booked this specific offer were entirely first-time visitors to an MGM property.
That is massive.
In a heavily saturated, mature market like Las Vegas, where organic first-time visitation is traditionally in the low double digits, capturing an entirely new cohort of customers is a monumental victory.
It is a masterclass in customer acquisition. You have to look at the all-inclusive package, not just as a way to fill rooms at the Excalibur, but as the top of a massive funnel.
Okay, walk me through that.
You bring in a new, likely younger, highly price-sensitive consumer. You stabilize the occupancy at your lower-tier properties, which prevents you from having to slash standard room rates. But the real prize is getting those 30,000 people into the MGM Rewards database.
Ah, customer lifetime value.
Precisely. Once they are in the database, the algorithm takes over. You track their spending, their preferences, their gaming habits.
And you market to them for life.
The long-term corporate strategy is to migrate that consumer up the loyalty ladder over the next decade. Today, they are buying an all-inclusive package at the Luxor. 5 years from now, as their income grows, you send them targeted offers to stay at the Park MGM.
And 10 years from now, they're booking suites at the Aria.
Exactly. You turn a perceived weakness, having older value-tier real estate, into the absolute strongest customer acquisition engine on the Strip.
It paints this picture of a perfectly oiled machine. But I have to stop us here, because I read the Q&A section of this earnings call very closely, and there is a massive red flag buried in the financial footnotes.
Ah, the pushback.
Yeah. I'm looking at that $25 million EBITDA jump on the Strip, and the pristine narrative starts to fracture. The CFO admitted, when pushed by an analyst, that a portion of this incredible Las Vegas profitability was driven by a hold benefit.
Right.
As an investor building a financial model, that phrasing makes me incredibly nervous. It sounds like they just got lucky at the tables. We cannot build a valuation model on pure luck.
Your skepticism is entirely justified, and this is the exact kind of nuance a retail investor must aggressively interrogate.
Yeah.
To understand a hold benefit, you have to understand the foundational mathematics of the casino industry.
Right. The house edge.
Yes. Hold is simply the percentage of chips purchased by players that the casino actually retains as profit at the end of the day. Every single game on the floor has a mathematically defined house edge.
So it's predictable.
Over millions of hands of blackjack, or millions of pulls on a slot machine, the math is absolute. The law of large numbers dictates that the casino knows exactly what their baseline revenue will be within a very tight margin of error.
The house always wins, eventually.
Eventually, yes.
Yeah.
But Las Vegas also caters to what the industry calls whales.
High rollers.
Right. Ultra high net worth individuals, often international, who play extremely volatile table games like baccarat. Management admitted on the call that they specifically cater to a small handful of these customers, maybe a half dozen to a dozen individuals who swing hard and swing heavy.
We're talking about customers betting hundreds of thousands of dollars on a single hand.
Easily. And when the bets get that large, the law of large numbers hasn't had time to play out. The variance is massive, meaning in any given weekend, the math can break. The player can go on a statistical anomaly of a run and win $10 million, effectively genting the casino's quarterly earnings. Or, conversely, the casino can run incredibly hot, hitting its statistical anomaly in the other direction, and wipe the player out faster than expected.
So a hold benefit simply means the casino caught a lucky mathematical variance against a few billionaires this quarter.
Yes, the house ran hot against the whales.
Wow.
The CFO understandably refused to give an exact granular dollar amount, but under pressure from analysts, he conceded that the benefit was in the tens of millions of dollars for the quarter.
Tens of millions in just pure luck.
If you are a retail investor, this is the most critical piece of information in the entire transcript. You cannot project future earnings based on a hold benefit. When you see that $25 million increase in Strip EBITDA, you have to surgically remove those tens of millions in pure luck to find the actual operational baseline of the business.
Okay, so the core business, the conventions, the digital growth, the live events, is still incredibly strong, but the headline numbers were undeniably inflated by Lady Luck, which naturally begs the question. If you are a multi-billion-dollar international corporation, you can't just cross your fingers and hope the baccarat tables run hot every quarter to appease Wall Street. How is management actually planning to engineer guaranteed structural growth over the next decade?
The answer lies in their multi-year capital expenditure strategy. They were taking the massive free cash flow generated by today's operations and deploying it into monumental projects that will define their footprint in the 2030s.
Let's talk about Japan.
The absolute crown jewel of this global expansion strategy is the MGM Osaka project in Japan.
The scale and ambition of the Osaka project are almost difficult to process. The CEO, Bill Hornbuckle, referred to it on the call as the greatest greenfield opportunity in the world.
And for anyone unfamiliar with the term, a greenfield project means you aren't buying an old casino and renovating it. You are taking a literal blank piece of land and building an integrated mega resort completely from scratch.
And doing it in a highly regulated, historically impenetrable market. Japan has been the white whale of the global gaming industry for decades.
Oh, absolutely.
It is one of the wealthiest, most populous developed nations on Earth, with a massive propensity for gaming, which historically was channeled into pachinko parlors. The geopolitical and economic significance of MGM securing this license just cannot be overstated.
They aren't just building a casino, they are building a massive economic engine for the Kansai region.
Management confirmed that the heavy lifting has already begun. The underground foundation work, the massive piling securing the structure against seismic activity is progressing, and the above-ground steel structure is actually beginning to take shape.
But the capital required to bring this to life is staggering.
I'll say. They are on track to deploy approximately $1 billion in 2027 and another $1 billion in 2028. This is a relentless march toward a grand opening in the fall of 2030.
The defining characteristic of this project, and the reason they are willing to sink billions of dollars into the ground, is the monopoly dynamic.
What do you mean?
They emphasized on the call that they are the only licensed operator in Japan. Contrast that with the Las Vegas Strip, where you have intense block-by-block warfare with competitors like Caesars and Wynn.
Right. They're fighting for every tourist.
Exactly. In Osaka, MGM will have an absolute government-sanctioned monopoly in a Tier 1 global economy. For a long-term investor mapping out cash flows into the next decade, Osaka is the massive, undeniable catalyst hovering on the horizon.
It's a massive bet on international expansion, but they are also pouring capital into fundamentally restructuring their domestic footprint. Specifically, they are pivoting hard into ultra-luxury.
The high end.
Yeah. The CEO mentioned dedicating significant growth capital to redesigning the convention and public areas at the Bellagio. They are exploring the construction of new ultra-luxury villas, noting they currently only have 8 of these elite properties in their inventory.
Which is pretty low for that market.
Right. And they're also remodeling high-end rooms at the Aria and the Cosmopolitan. Hornbuckle explicitly stated their mandate is to expand the very definition of luxury. Why target such a narrow demographic?
It is a highly calculated defensive strategy against macroeconomic turbulence.
Defensive.
Yeah, think about it. During periods of inflation or economic uncertainty, the middle-class consumer tightens their belt. They skip the annual Vegas trip or they trade down to a cheaper hotel.
Right, they cut discretionary spending.
But the ultra-wealthy consumer, however, is generally insulated from these financial shocks. Their discretionary spending remains largely untouched.
They're basically recession-proof.
Exactly. By heavily investing in the absolute top tier of their portfolio, the multi-million-dollar villas, the exclusive high-limit gaming salons, the bespoke culinary experiences, MGM is ensuring they capture the most resilient, highest-margin demographic available.
They're chasing quality over quantity.
They're making a structural, long-term decision that the future of Las Vegas revenue growth lies not in volume, but at the very peak of the economic pyramid.
We see that same luxury-first playbook being executed perfectly when we look at their operations in Macau.
Macau is fascinating right now.
MGM China is such an interesting case study, especially regarding how vulnerable global gaming is to broader cultural events. The CFO noted a very specific detail. They saw a slight volume dip in their Macau operations in June, and they directly attributed it to the World Cup taking place.
It perfectly illustrates how interconnected global consumer behavior has become. When you are targeting the premium mass and VIP segments in Asia, you are dealing with a demographic that is highly mobile and globally engaged.
Right, they follow the big events.
Yeah, a massive soccer tournament happening in another time zone temporarily derailed casino volumes in Macau because the target demographic was either traveling to attend the games or staying home, adjusting their sleep schedules to watch the broadcasts.
The entertainment dollars and attention were temporarily diverted.
But management was adamant in classifying this as a transitory event rather than a secular shift.
Which is a very polite Wall Street way of saying it was a temporary blip, not a permanent change in how people gamble.
And the subsequent data entirely vindicates them. By July, as the tournament concluded, they reported that volumes in Macau came roaring back, actually exceeding their incredibly strong Q1 levels.
So they recovered immediately.
They are maintaining a highly dominant 16.4% market share in the region.
Which is incredible given their physical footprint is smaller than some of their legacy competitors in Macau.
They are achieving that market share through hyper-targeted capital allocation. Just like in Vegas, they recently debuted new ultra-luxury villas in Macau, and expanded their premium mass offerings by adding 50,000 square feet of high-end exclusive gaming space.
They are relentlessly targeting the premium customer across every geographic border.
It's remarkably consistent.
Okay, we have covered the domestic omni-channel growth, the convention strategy, the sheer luck of the baccarat hold, the $2 billion Japanese monopoly, and the Macau rebound.
We covered a lot of ground.
But we have to address the elephant in the room. Right at the very beginning of the earnings call, before they even discussed a single revenue figure, CEO Bill Hornbuckle addressed an unsolicited acquisition offer from a company called People Inc., which is an entity associated with billionaire Barry Diller.
Yeah, that was wild.
And the moment he brought it up, he instantly built an impenetrable wall around it.
What's fascinating here is the psychology of how management handled this. It is a masterclass in corporate communication and narrative control.
Because buyouts are usually messy.
An unsolicited buyout offer is inherently chaotic. It dominates financial news networks, it makes institutional investors jittery, and it usually derails an earnings call as analysts try to pry for details.
But the CEO simply stated that a special committee of independent directors had been formed. He emphasized that these directors have zero ties to the company making the offer, and they are evaluating the proposal with outside financial and legal advisors.
And then he shut it down.
Right. He delivered a blunt directive. He stated that neither he nor the CFO would answer a single question on the topic during the Q&A session.
By establishing an independent committee, management effectively recuses themselves from the drama. They build a legal and operational firewall. But the true victory was enforcing the blackout during the Q&A.
Analysts usually push back on that, right?
The analysts on these calls are paid to poke and prod at any sign of weakness or uncertainty. Yet, not a single analyst even attempted to ask about the buyout. Management successfully forced Wall Street to focus entirely on the operational triumphs of the quarter.
It projects an aura of immense, unbothered confidence. They're signaling to the market, look, we have hired lawyers to deal with the corporate espionage. We're too busy running a highly profitable, record-breaking global empire to discuss it.
They did not let a speculative financial event overshadow the tangible, fundamental strength of the cash-generating business.
It was ruthless discipline, and it worked perfectly. So we've spent this entire deep dive tearing apart the transcript, analyzing the revenue streams, separating the strategic genius from the mathematical luck, and mapping out their global expansion.
It's time for the verdict.
Exactly. So what does this all mean? For the retail investor listening to this right now, weighing their options and looking at their portfolio, we need to deliver a verdict on the stock. And looking at the totality of the data, the aggressive buybacks, and the future pipeline, I am calling this a definitively bullish signal.
The data supports a highly bullish thesis. The core business is firing on all cylinders, and the management team is demonstrating an extraordinary ability to balance wildly different consumer demographics simultaneously.
They're hitting every segment.
On one end of the spectrum, they are pioneering an all-inclusive package that serves as a massive funnel, drawing a brand new, budget-conscious generation of customers into their loyalty ecosystem.
The Excalibur experiment.
Right. And then on the other end, they are aggressively leaning into the ultra-luxury sector, dominating the high-margin corporate convention business, and capturing the massive influx of affluent, event-driven travel.
And for the individual holding the stock, the share buyback program is the ultimate reward. When a management team is disciplined enough to reduce their outstanding share count by 50% over 5 years, they are systematically enriching their shareholders without triggering the tax liabilities associated with a traditional dividend.
They believe the stock is cheap at $37.
And they are spending hundreds of millions of dollars to prove it.
However, a bullish verdict does not mean you abandon analytical rigor. The actionable advice for any investor building a model based on this quarter is absolute discipline regarding the Q2 data.
You're talking about the whales.
Yes.
Yeah.
You must surgically back out the tens of millions of dollars they gained from the lucky hold benefit against the baccarat whales. Do not build a financial projection that assumes MGM will simply run mathematically hot every single quarter.
You can't model luck.
No, you can't. Look at the baseline revenue driven by the 20% convention mix, the stabilizing regional assets, and the structural growth in the digital arm as your true indicators of long-term operational health. Base your optimism on the concrete fundamentals, not the luck of the draw.
That is the exact kind of clear-eyed analysis we aim for. But as we wrap up this deep dive, we want to leave you with a final thought. Something that wasn't explicitly debated by the analysts on the call, but is the unavoidable, logical conclusion of everything management laid out today.
This raises an important question. Throughout the transcript, management was incredibly explicit about where they are deploying their capital. They are relentlessly focusing on luxury and luxury experiences.
The villas, the remodels.
They are building exclusive villas, remodeling high-end suites, and configuring their properties to capture the ultra-wealthy international traveler and the corporate elite. But this raises a profound structural question about the future of their brand. By aggressively chasing the absolute top end of the market, are they slowly pricing out the middle-class consumer that historically built the foundation of Las Vegas?
It is the classic gentrification dilemma, but applied to a massive casino empire.
Precisely. If a severe macroeconomic downturn hits in the late 2020s, the ultra-wealthy might continue to travel. But the middle class, the casual vacationers who fill the standard rooms, will disappear entirely.
And then what?
Exactly. Will leaving their budget-conscious roots behind make their bottom line more resilient because they cater exclusively to the rich? Or will it make them far more vulnerable because they have permanently alienated the mass market?
That's the billion-dollar question.
The all-inclusive package of the Luxor is a clever band-aid for today's older properties, but the billions of dollars in capex being spent on tomorrow are decidedly aimed at the 1%. How that tension resolves over the next decade will define the future of MGM Resorts.
It is a phenomenal question to ponder as you evaluate your position in the company. Thank you for joining us as we hacked our way through the Wall Street jargon to find the signal in the noise. Keep asking the hard questions, keep looking past the headline numbers, and we will see you on the next deep dive.